Hey guys, this is PC here from Global Alpha Search. You're possibly wondering, as most of the other investors, when is the next big correction going to come and what is going to be the trigger? My thesis that I have been repeating for quite a bit of time already is that the next bigger correction, so a correction of in the range of at least 10 to 20% is going to happen when the Fed allows it. We as investors right now are having a big put option bought against the Fed, and we have been through this already during the last economic cycle, and this is repeating right now. So as long as the Fed allows the markets to not to correct, the correction is most possibly not going to come, or at least the correction is going to be pretty small in its size and scope. Let me just run you very quickly through a slide that I have prepared for you today for this video, which I think will convince you to my thesis. Here you see a graph that includes two things mainly. The red line are year-on-year percent dynamics of the S&P. So these are the year-on-year returns of the equity market. And the blue line here is the year-on-year dynamics of the Fed's assets, total assets on their balance sheet. As you see here, over the longer period of time, there is a very close relationship between those two. And this has been like this since ever we've got QE on. So let's say at around the start of 2009. And this is very important to keep in mind that, the Fed is having our back basically. And that's what the markets are all about in the long term right now. So as you see here, over the period of 2012 to 2018, we had a period of the year-on-year dynamics of the assets on the balance sheet of the Fed being either flat, as here between 2012 and 2013, and here between, let's say, 2015 roughly to 2018. And we had a period in between then when the assets were, asset dynamics was growing. So as long as the year-on-year dynamics of the assets purchases were either flat or positive, the year-on-year returns of the equity markets were very positive, somewhere between, let's say, 0 to 40%, but on average 20-25% possibly. And this is a very, very close relationship. This obviously has a lot of logic behind it, but in this video I will not go into details. What I want to concentrate on is here, for now, taper tantrum and the preparation for the first rate hike, which happened here at the start of 2016. As you saw at the end of 2014, the Fed has announced that it plans to start reducing the asset purchases. They were still positive, but the dynamics over here started falling, as you see, and this caused directly in the longer run that the dynamics of the year-on-year changes of the S&P were also falling. They were still pretty positive, somewhere between 15 to 20% possibly, but they were falling, right? This is a very important tendency here, and this shows that it's basically a big play between what the Fed wants the market to be thinking and how much the market has really digested what the Fed wants us to tell. It took roughly 3 years for the Fed to prepare the market to live without its own injections, let's say, right? And here it started decreasing their asset purchases dynamics. And in here, at around the start of 2016, is when we got the first rate hike from the Fed. And as you see, the market was well prepared already for that, because that's exactly when we went into the early expansion phase, where the market was already strong enough to grow with higher interest rates, higher price of money, and without additional asset purchases. As you see here, the dynamics were flat between 2016 to 2018. Later into the expansion, the Fed even allowed itself to not only increase the price of money, measured by the Fed fund rates, but also decreased their balance sheets. So the year-on-year dynamics of the asset purchases were actually negative here, right? So we had a very strong economy that had to be calmed down kind of by the Fed, either by higher interest rates or by tapering their assets on the balance sheet, right? The year-on-year returns of the S&P were still very positive here, somewhere between let's say 0 to 20% on the average, possibly 15-17%, but they were still positive, right? Then we entered the boom at the start of 2019. So we had quite a bit of instability basically grinding into the markets. We had an inverting yield curve. We had a wobbly industrial production. We had troubles and tensions in the labor market already. And that's when the Fed started feeling it, and they started already increasing a little bit their assets on the balance sheet to kind of decrease the negative instability effects. And as we entered the recession in February last year, obviously the dynamics in the asset purchases skyrocketed from around 0 to 5% up to 70%. And that's the situation that basically lasted until, let's say, April, May this year, and only then the Fed felt strong enough and confident enough to start decreasing their asset purchases dynamics, and this obviously had a direct effect on the year-on-year dynamics of the equity markets as well. So guys, the lesson for today: there's a very close relationship between the assets on the balance sheet of the Fed and how the markets perform. So stay cool, stay calm, and watch the Fed. This is the saying that I want to stick to. And always please remember that. That's it for today, guys. I hope this video was useful for you. Ping me a comment if you liked it, and contact me on my email or on my social media if you please. Thank you very much. Have a good day.